I'm gonna record. There it is. Okay, perfect. We got some people still pouring in, but we'll start. I'm going to jump right into it. I looked at the news for last week. Pretty much everything is the same. Rates are still elevated. Inflation did come in. Personal consumption expenditure came in last week and did show that it's declining little by little. The Fed has their meeting this week on what today's Monday on Wednesday, and most likely won't be increasing or increasing the Fed funds rate. I think that they've kind of already settled that they're going to keep it at where it's at. It looks like for initial jobless claims, we got an increase of about 10,000 last week to 210,000, and continuing claims are increasing now, which means that people are actually not getting jobs as quickly as they were before. Last week, I mentioned to you guys the warn notice as well was sent out. A few companies sent out their warn notice, which is basically, if you have more than 100 employees and you plan on getting rid of at least 50 of them, you need to give them about 60 days notice before you do so. And there was an increase in those warn notices from the news that I gave you guys last week. In terms of interest rates, they took a dip last week, but they're opening up today. The 10-year treasury is at 4.9. The highest that we've seen it kind of hit these past couple of weeks is at 5. It was 5 flat. But mortgage rates right to open up the day are not doing too well. And everything is still kind of elevated. I know pending home sales came in, and they're actually increased year over year, which is obvious, right? We talk about this often. Pending home sales are going to continue to show good numbers because there isn't a lot of inventory, right? And so without a lot of inventory, those pending homes, or sorry, the actual average purchase price for homes is going to continue to increase over time. New home sales, which is new construction homes, showed a month over month increase of 12%, and they're actually up 33% year over year. But remember, those new home sales are from builds that were planned ahead of time or within the last few months, right? Because it takes some time to get those builds going, 6 to 12 usually. Okay. What I really want to kind of jump into today is two main topics. One is going to be condo financing, directly boots on the ground, the issues that I'm coming across, so that way you guys can see, within our neighborhood board chat, Tamika Moses did post something about condo foreclosures going to be rising soon and stuff like that. And actually, it's funny because I already kind of put something together for you guys to see. Really what's going on and what I believe, which is the same thing based off of actually very recent transactions that we've been going through. But also Hometown Heroes, the board approved on Friday $36 million of funding for Hometown Heroes. I got it confirmed directly from Sandy Smith and Charles White, which are both the admins of Florida Housing and Hometown Heroes specifically. It's going to stay the same. It's the full-time employee, 35 more hours a week with a Florida-based company, or if you're self-employed, being full-time as a self-employed person within the state of Florida as well, with your business being registered here. Okay, so that is actually great news. It's only 36. It's a third of the money that they came out with originally. We know that the first time the funds ran out in 2 months. So we can only assume that, these will run out by November-ish, which honestly, looking at it, from my perspective, I think that's okay. Because I know you guys felt it because I called on a few of you guys and I called other people in the industry, right? October was actually very slow lead-wise, contract-wise, a lot of clients kind of getting unmotivated. And really what everybody's looking for is 2024. So if we've got kind of this buffer, right, where we can keep traction going in our businesses in terms of still being able to try to get people under contract and stuff like that, right? That could actually help us through these tougher months, because usually the fourth quarter is the slowest, right? November, December. Right. You're getting these leads coming in and say, hey, there's only 36 million, start getting going. Now you guys got Christmas money, right? Got money for the kids, even if you go under contract on one or two clients that wouldn't have gone under contract had Hometown Heroes not been there. So I think this is good news to kind of end the year, even though the funds may be gone, by the end of November. Starting in January, February is where a lot of people are going to be starting to kind of get their feet wet, even if rates are still elevated, because there's so much pent up demand and everybody's just waiting, right? Waiting for the end of the year. And then when January, February comes around, when people start doing their taxes and they realize that the industry or the market hasn't changed in 2 years that we've been like this, that pent up demand is going to start coming out little by little. And if rates start to dip by next year, as well within that same time frame, now you're going to get an influx of even more people, right? And so I think this is good news. I wish it was more, right? I think we all do, but think of it that way, where it was probably going to be a slower fourth quarter for you guys, for us as well in the team. We do a lot, and we were already feeling it ourselves. So I can imagine, everybody on this phone call, how you guys were feeling. I'm actually pretty excited. If we can get through November, December, January, February, March is going to be much, much better. Or 2024 in general is going to be much, much better. So we are going to be reaching out to a lot of the clients you guys have sent us, most of the clients that you guys have sent us today, and we'll probably be on the phones all day, helping you guys and helping your businesses and getting these clients back into the motion of looking and excited to be able to purchase. We've already made a couple phone calls this morning, but you guys should be doing the same as soon as we get off here, right? And then reaching out, Mike spoke to this person, make sure to get in contact with them. And we'll do that between today, tomorrow, and Wednesday. We'll be trying to hit as many people as we possibly can. The funds are expected to be available by the end of this week. Tomorrow is the typical rollout day for the funds that are left over. So starting tomorrow, there will be some funds available. Sandy Smith said that by the end of this week, the rest of the 36 million should be ready to be able to start being captured. So if you go under contract before them, it's not a big deal. As soon as they open those funds up, you guys, the loan officer can lock in the funds for that client at the end of the week. Okay. And I don't know if you guys have any questions before I jump onto the condo financing portion. No? All right. I'm going to be sharing my screen
Yeah,
here.
I did. I'm sorry.
Oh, go ahead. Go ahead, Carl.
I thought I was muted. Question. With the Hometown Heroes, next year, are we expecting them to fund Hometown Heroes next year, or
Yeah.
do we know?
Yeah, so it is put into place as a law now, and it should be renewed every single July. But from now to July, I guess the board approved that extra $36 million of funding for the program. But yeah, every single July, it's going to be refunded. That $100 million should be available for first time home buyers every single July.
Thank you.
No problem.
Mike, I have a question. I think you said it, but it's the same amount, right? Up to 5% of your purchase price, 35,000.
Yeah. So same amount.
Okay.
It's the same requirement. Full-time employees, 35 hours a week. It's not the original one that came out that was just for frontline workers, heroes. It is going to be available for every first-time home buyer in the state of Florida.
Okay, thanks.
No problem. So story time. Okay. We've got a lot of people that are trying to get under contract on condos. That's where a lot of budgets are right now when you're talking about affordability and what, people on one person on an application, what they can really be able to afford, even if the HOA dues are a little bit elevated, right? If you're making $60,000, $70,000 a year right now, you're probably going to get approved for about $2,300 a month, depending on your liabilities. That puts you right around the condo range, because it's about $200,000 on a condo. So that's even on the lower end. But that's more or less depending on, your debt to income ratio and stuff like that. So this client specifically has been under contract on 2 different condos, and it happened on both of them. Okay. Fannie Mae has this condo portal. I spoke to you guys about it about a month or 2 ago. Okay, within this condo portal, a lot of loan officers, I don't know within other companies if they have access or not, but I know that a lot of the underwriters and a lot of, well, every single company has to abide by this condo portal. Okay, I'm blessed enough to be able to have access to it, and it gives us a head start, but it's not perfect. Okay, so this client went under contract on this specific condo back in September, was scheduled to close at the beginning of November, gave himself some time because the one that condo that he went on under before, something similar happened, where the insurance wasn't sufficient, which we'll talk about. And because of that, it ended up on the unavailable list while we were under contract. And so we had to back out of that one. He went under contract on this one, Tallwood East. And I looked and I said, hey, this is not on the unavailable list. Let's try to get these documents in as soon as possible, and try to close this as soon as possible because we can't risk it. They are flipping these condos to unavailable like they're freaking burgers at McDonald's. I'm not kidding. These things are going on the unavailable list quicker than you can blink, and it makes condo financing very, very scary for a lot of people, and it costs them a lot of money, and it puts lenders and realtors in a position, in a very tough position, because if you're not smart or you're not moving quickly on these things and you're not paying attention to these lists as every single
Lost your mic.
Okay, I thought it was just me.
Looked like he got dropped out.
Yeah, he did. He'll probably be back soon.
Make me the host. Yay, you're back.
wait, the thing stayed open?
Yeah, we were still here. We were waiting for you to come back. I had just texted you and asked you if you wanted us to drop off.
No, the internet went out. I don't know what the hell happened.
Oh, okay.
Yeah. No. All right. I didn't even know that it would still keep you guys in here. That's pretty cool. Okay.
That's what I was
So-
shocked too.
Sorry about that. All right. So this was put on the unavailable list 6 days ago. And this guy was under contract. We got the condo questionnaire in on the 23rd. And I remember because I was sitting down with my team when the condo questionnaire came in to review it, to make sure that there was nothing critical on the condo questionnaire in and of itself. So we looked on the Fannie Mae list one last time before we submitted this over to the condo department for their review. Not on the unavailable list, perfect. We send it in for review on the 24th. My condo department emails and says, hey, this was just put on the unavailable list. Today, we can no longer do the financing for this, just like that, right? Within a day. And this is happening consistently. There's another one that we were under contract with recently, Falls of Inverary, which has a lot of different buildings. And a lot of people go under contract in Falls of Inverary. And recently what happened, and you'll see this one as well, updated 10-9, right? We found out 2-3 days after. So what happened with Falls of Inverary specifically spoke to the management company. Before, the management company for Falls of Inverary was First Service Residential. You guys may know them. They do a lot of, they are property managers for a lot of different associations here. In my opinion, First Service Residential and the experience that I've always had with them is they've always had their paperwork in order. Communication sometimes is good, sometimes it's not. But in terms of their paperwork and their documentation, most of their condos in the past have been in good standing. Okay. There is a new associate or property manager on these, or management company on Falls of Inverary, Orange or something like that. But I guess it was time came to renew their insurance, their master insurance on their on all their buildings, and the insurance, of course, required an inspection. You know that insurance costs are continuing to rise, especially in Florida, and the insurance basically, the insurance inspection basically came back saying that they needed to update their roofs and renew their roof. If they kept the same insurance that they had before, they would have had to basically put an assessment on every single owner for $1,000 a month in order to keep that same insurance. So obviously, what did they do? They lowered their insurance. They increased their deductible to 10%, which is against Fannie Mae compliance, and which they did it back in about August, I think August or September. And Fannie Mae, either a lender reported them or Fannie Mae did their review of that of theirs and basically put them on the unavailable list in the beginning of October. I had 2 people under contract within Falls of Inverary. Both had to back out. One of them, she kind of lost hope a little bit, which I understand her. And then the other one is now still looking for another property. But this happens, and it kind of blows the wind out of the sails of a lot of clients, because they feel like they've invested $300 on inspection, $400 or $500 on the condo questionnaire and this, and you come down to it, and there's really nothing you can do except for make this or do this as a non-QM, right? Not basically a private loan, and do it with those lenders. The problem is with those lenders is their restrictions are a little bit tougher depending on your credit score, right? It will depend on how much down payment you need to put. The interest rates are higher, and it makes it a little bit more difficult for those clients, even if they may be perfect, right? They've got the credit score and everything, but they're coming in with 5%. Now they can't do 5%. They may have to do 10 or 15%. And that will kind of throw them off as well. Okay. And actually, a lot of non-QM lenders, they're updating their guidelines from the conversations I had, but a lot of them don't even do 10% deductibles yet either, right? So they have also pretty strict requirements on their non-warrantable condos now too. So really what I want you guys to know, and what I want you guys to make, yes, Dr. Carlo.
Figure out what are some key indicators. So
Yeah.
you think about if they need to be if they're renewing their insurance, and I already know if they're up for 40-year recertification. Anything else you're noticing as a trend that maybe we find out on the front end?
Yeah, so that's what I was going to tell you guys. What we want to do, and which is what I've already told the team that we're going to be doing now moving forward, is we can no longer depend on the condo CPM. It's great to catch something that's already on the unavailable, but if it's not on the unavailable, we need to rush these things, get these things in, and try to get to closing as soon as possible. So, of course, the budget is still something that we need to get up front. The budget, the master insurance policy, as soon as we go under contract, because sometimes you got to pay for that, $30 or whatever. But the master insurance policy should be one of the things we get right away, up front, day 1, day 2 of being under contract. If the listing agent has it beforehand, great. we can get a copy from them. If they don't, and the client has to invest some sort of money to pull it up from the online system that a lot of insurance companies have it, that's okay. We'll do that. The master insurance policy, and then also emailing the association directly, asking them if they're due for their 40-year recertification, and if they are, have they already done their inspection? And did the inspection show that there needs to be anything that if there's any sort of safety or structural issues that need to be repaired or redone? Okay, it's a 3-part question, but that's really important. Is there 40-year or 50-year due? If so, have they done their inspection already for it? And did that inspection yield any results of things that they need to get done? Okay. And then, of course, the other question is going to be, are they going through any sort of major litigation now? But those are going to be the big ones that I'm seeing consistently. Insurance is killing deals left and right because insurance is renewed every single year. And Jay, I got you in a second. Insurance is renewed every single year. And as soon as they're getting those insurance premiums, what's happening is they're getting hit with these large increases. But you guys know that associations, one, they're not really good at managing their budget, and two, most of their budgets essentially end at zero, right? Because they're going to take in as much money as they're spending. So if that insurance premium comes in and it increases, they're not going to be losing money. So there's one or two things are going to happen. They're going to put up a special assessment, and they're going to charge the owners more, and that special assessment hopefully is on the listing. But if not, that's something that we need to be aware of. Or two, they're just going to lower the insurance because they have no idea what's going on yet when it comes to these condos and this condo financing as an association in and of itself. Jay, your question?
Yeah, I came in a little bit late. I just wanted to know what's going on with Inverary.
So yeah, Inverary, and actually we closed this one, but they changed their insurance, and
Just in the middle like that?
yeah, they increased their deductible. No, I think their insurance was already up around the time that we were closing. So they switched it and they increased their deductible to 10%, and they lowered their coverage. So they're not at 100% replacement cost. I think they were, it takes $8 million to replace that specific building, and they're at $5 million, right? And so if you're less than 100% replacement cost, you're not going to be able to get financing. That's a huge risk, and that's against Fannie Mae guidelines, right? And then also the deductible cannot be it cannot be 10% or greater. It has to be lower than 10% in terms of the wind deductible that you have. So that's what happened with Falls of Inverary. But those are really the things. Is getting that master insurance policy, I think, is so critical right now because, like I mentioned, insurance is renewed every single year, and those premiums are coming in increasing left and right. The budget, of course, making sure, especially if they're not on the Fannie Mae approved list, making sure that budget is is good and intact to be able to do a full review. If not, doing a limited review is fine. What a lot of people don't know is that if the association is not collecting a budget or reserves at all, Fannie Mae said that not even a limited review can be done. I want you guys to understand this, okay? If you have a client that's putting 20-25% down, there is no more, okay, then we don't need reserves. No, you just don't need 10% reserves, but you do need money in a reserve account to show that they have money in an account. That's why they're not collecting it, or they need to be collecting some sort of money for reserves, even if it's not 10%, in order to be able to do Fannie Mae limited review. There is no more, we don't have a reserve account and there is no reserves financing for 25%. That's not the case anymore. Okay, they need to have some sort of reserves, whether that be in an account or collecting it, okay? Do you guys have any questions so far? No. So one last thing before I get off the condo thing, right? I think now moving forward, right, increasing association dues on people, on these owners, right? Obviously, the current owners that are there are going to are going to feel it, right? A lot of them may end up going through some sort of foreclosure process because they can't keep up with these association dues that are increasing in order for the association to be able to still be financeable. And if those assessments are not there because the association is now lowering their insurance or doing these specific things that are not getting them compliant so to say. What happens is that barrier to entry is much, much higher for buyers. And over time, that association and those units within that association will now start to decrease in terms of pricing, right? The demand may be there, but now if you're telling everybody that you need to do this non-warrantable, right? How many people are really able to do that 10, 15, 20%, take a 10, 11% interest rate and still be able to qualify at an elevated price point, right? Not a lot. And so you either have the issue where, a lot of your unit owners are going to be getting into these tough positions and have to sell, and then your unit prices are going to come down either way, or you don't do anything, at least for the short term, and you get on this unavailable list, and now your prices still start to drop because nobody can sell their units. So I think it's a very, very tough position for condos, right? Those 40-year recertifications, those 50-year recertifications, they're pretty much that, and insurance are the two deal killers when it comes to condos right now. And whatever you can do to protect your client, try to get that documentation up front as soon as possible to be able to save them. But yes, right, you can, if your client does qualify for some sort of, and I know Lorraine mentioned it here, if your client does, qualify for some sort of down payment assistance, they may not be able to do the in-houses because the in-houses are only standard FHA conventional VA, but may be able to do these non-QMs to be able to help them with that difference, right? The only thing is the non-QM may not allow for an elevated combined loan to value, but that $50,000 could be used to lower the original loan amount that you're going to be getting from that non-QM lender and lower that payment for that client as well. Okay. You guys have any questions? No, we're good to go. Guys, thank you so much for joining me again. We'll be back next Monday. Next Monday, I'm going to try to get a guest on here, and we'll talk about what I'm doing as well in terms of YRD, the Young Realtors Division for NAREB. I'd like for everybody on this call to be able to be a part of it. I'll go more in depth next week. But we will have Rashida. She is the president, but she has an interesting take on the buyer commissions that are being fought for, and what she thinks that means for buyers, agents, and stuff like that. Actually, everybody that I've spoken to besides her thinks it's something that sucks for buyers, agents, and she actually has the opposite opinion. And we had an interesting conversation over the weekend. So I'm going to be bringing her. I'm going to be trying to get her to get on with us next Monday so she can give you her take and maybe change the view of the way that you're thinking about this lawsuit. Okay. Thank you, guys. We'll talk next week.
Thank you, Mike. Have a great week.
No problem. You too.
Thanks.